Hey folks, it's Kevin. In this video, we're talking about the total cost to purchasing a home. After watching this video, you'll know exactly how much you need to have saved in order to be eligible to purchase. And lastly, we'll be going over different loan programs and some hidden fees that are charged. So let's get right into it. Naturally, the first thing that people think of when purchasing a home and bringing cash to the closing table is going to be the down payment. Now, each loan program has different guidelines as far as what the minimum down payment requirements are, so we'll go ahead and cover the three most common loan programs that are used today. The first is going to be for active and former military, and that's also known as the VA loan, which has a 0% down payment requirement. Yes, that is right. You do not need to put any money down. However, you can if you choose, and by doing so, you'll ultimately reduce your monthly payment. The second most commonly used loan program is going to be a government-backed loan program called the FHA loan, commonly used by first-time home buyers. The minimum down payment requirement for this loan product is a 3.5% down payment, and that does not matter what the price of the home is. Lastly, we will cover a conventional loan, which is just a standard loan that any bank can issue. It is not backed by the government, and the minimum down payment requirement for this is 3% up to about $580,000 in price. Once you purchase a home that exceeds that amount, the minimum down payment requirement is then increased to 5%. The second cost you're going to want to plan for is closing costs. In theory, this can be a number of different fees, but I'll do my best to simplify what the larger majority of the makeup of those closing costs are. Here in San Diego, the average is about 2 to 2.5% of the sales price of the home, which can range anywhere from $12,000 to $15,000 just in closing costs alone. The closing cost, the larger majority that is made up of those, goes towards impounding 6 months worth of taxes and insurance. And so every month that you make your monthly payment, although you're still putting money towards taxes and insurance, you're always 6 months ahead. And then there are going to be costs for escrow and title services as well. Escrow is a neutral third party who holds all the funds in the escrow account throughout the duration of the escrow period, which on average is about 30 days here in San Diego. They will also make sure that they're communicating with the title insurance as well as the lender, the sellers, and the buyer to make sure that everybody is cohesive and agree to all terms per the contract and any negotiation that goes on throughout the duration of that transaction. Title insurance is a little bit different, and what they do is they make sure that the buyer is in fact who they say they are and nobody's fraudulently purchasing a home in your name, also known as a straw buyer, and that a seller doesn't have any liens preventing them from selling their residence, such as solar liens, tax liens, which we commonly see. Well, I know what you're probably thinking, Kevin, if I've paid $12,000 or $15,000 in closing costs on a $600,000 transaction, am I really putting all of that money towards insurance, taxes, and title and escrow fees? The short answer is no. But in order to get into specifics, it would take a long time for me to put that in this video. So rather, what I'm going to do is I'm just going to go ahead and post on the screen what all of the common fees that we see in today's market. Now that you're aware of the many fees that could potentially be included in those closing costs, I'd like to talk about one specific fee that often goes unnoticed and buyers end up paying for it in escrow without ever knowing about it. And that's called the origination fee. Now, what this fee is it's an origination charge that's made by the lender or the bank for originating that loan. This can range from a couple $100s to a few $1,000s, which is a wide range, and the lender or bank can decide what they want to charge to any specific buyer. Have you ever been shopping around rates and you notice that one specific lender or bank is advertising a rate that nobody else can compete with? Well, when you pull back the curtain, you'll see that it's because they're charging an erroneous fee on the back end. Now, some lenders refer to this as discount points, which is when a buyer chooses to pay money to that lender to get a lower interest rate, which ultimately gives them a lower monthly payment. I'll link a video to that up above. But what I'm talking about is an origination fee, which is when a lender charges money to a buyer for originating that loan or creating that loan and offering it to them. Well, the reason why lenders don't call this discount points is because they understand that most people know what that is and they're not interested in paying additional money to get a lower interest rate. So in turn, what they do is they just call it an origination fee and just say that's the cost of doing business. The easiest way to avoid this is simply asking the lender that you're getting pre-approved with what their origination fee is, as well as what their par rate that they're offering you is, which is simply the rate that they're offering you that doesn't cost you any money. By shopping around and taking those quotes to different financial institutions, ultimately you're going to be able to reduce that origination fee and get the best interest rate possible. Thank you so much for watching this video. I hope it was of value. If it was, please hit the like button, send it to a friend or a family member that you think can benefit from it. Maybe they're shopping around lenders and maybe they're looking to purchase a home. And lastly, subscribe to my channel and stay tuned for any future videos. I'll see you in the next one.